And welcome to NTD Business. I'm Don Ma. A number of things to talk about today. Markets are anticipating a flood of hundreds of billions of dollars of U.S. Treasuries and has some worry that it could cause disruptions. The Treasury Department is trying to replenish its funds because during the debt ceiling debate, the Treasury used extraordinary measures to keep paying the government's bills. And that has drained its checking account. In light of that, there's expectation that there will be an unprecedented surge in the amount of cash being raised in the ensuing months by issuing treasuries. More than $800 billion of treasuries could be issued within a short amount of time. The sudden influx of more than $800 billion in new debt could potentially overwhelm the market if there's not enough demand to absorb it. Increased supply of bonds without a corresponding increase in demand could put downward pressure on bond prices and increase yields. There are concerns that this may jolt markets and raise short-term borrowing costs. But just to put things into perspective, few expect major upheaval in the long term. Meanwhile, the U.S. trade deficit widened by the most in 8 years in April as imports of goods rebounded while exports of energy products declined. Now, if this continues, it could result in trade being a drag on economic growth in the second quarter. The Commerce Department said today that the trade deficit jumped 23%, the sharpest percentage increase since March 2015. It raised the deficit to the highest level in 6 months. Here's a comment from Chief Economist Christopher Rupke at FDW Bonds in New York. Quote, "The terms of trade are worsening, and this will bring down second quarter estimates of real GDP growth closer to the 1% stall speed where bad things can happen and the economy can stumble and go over the cliff." Exports are being crimped by slowing global demand. The U.S. dollar remains strong, making U.S.-made goods less competitive on the global market. April's drop in goods exports was led by a sharp decline in exports of industrial supplies and materials, mostly crude oil and fuel oil. There was also a big decline in exports of consumer goods. Now, exports of services, however, increased to a record $81.9 billion, was lifted by travel and other business services. Now on to whether the Fed will raise rates at the next meeting. It seems like the U.S. Federal Reserve will actually not raise interest rates for the first time in well over a year at its June 13-14th meeting. Now, this is according to economists polled by Reuters. But at the same time, a significant minority still expects at least one more hike this year as the economy remains resilient. Fed Chair Jerome Powell signaled in May that the U.S. Central Bank might soon pause its hiking cycle to assess the impact of an historically aggressive 500 basis points worth of tightening, having raised rates at every meeting since March of 2022. More than 90% of economists polled on June 2nd to 7th said officials will hold interest rates. Since the Fed's last policy meeting in May, strong economic data and comments from a few of its officials have encouraged markets to price in a hike at or before the July meeting. But the trouble is inflation has not fallen quickly enough. It was running in April at 4.4% based on the Fed's preferred measure. And in the meantime, the U.S. job market has remained remarkably strong with unemployment rising, but still remaining well below 4% and wage inflation falling slowly. The housing market as well is normally highly sensitive to interest rates. It has also withstood the higher borrowing costs for much longer than many expected, with only minor price falls from the levels seen during the pandemic-related boom. And here to talk to me is Tavi Costa, Portfolio Manager at Crescat Capital. Now, the big question a lot of investors are wondering right now is, will the Fed hike or pause at the next meeting? As a portfolio manager yourself, what do you think?
That's a good question. I'm also struggling to answer that question. I think right now in the markets is about probability of 30% of increase. I would say that I think it's a lot closer to 50% personally. That's the way I see it. I don't know if that matters as much as the market thinks it does, meaning I think just the fact that interest rates will stay where they are and continue to stay where they are, it will, in my opinion, unleash even more pressure in some parts of the market. We've seen this rally in mega caps recently, which I think it's unjustifiable for many reasons. I understand the thesis on AI and so forth, but I don't think, if anything, what we're seeing is an enabler of small cap companies to catch up with the bigger cap companies by using what I call it almost a perfect assistant to any business, and which is Chat GPT and other AI tools that have been used. And so I think the valuation spread between the overall market relative to mega caps needs to be reflected on that. As far as the Fed, I mean, we've had the banking crisis happen, and then things sort of go back to normal. If you look at the balance sheet has increased first, and now it's been coming back lower. The big news, in my opinion, is the debt ceiling situation, where things supposedly got resolved and extending the debt limit. But as we explain in our letter, it's not necessarily the risk of getting that extended, is the amount of issuances of treasuries that are likely to become a problem in the near future. And I'm questioning who will be the buyer of those instruments, especially at a time when about 40% of the government debt would need to be rolled. And majority of that debt is currently an average interest rate of about 2.6%, which is very, very out of the reality of where rates are currently, especially in the short term, where you can get over to 5.5% or so in interest rates. And so it is, I think this is really the dilemma, and I think will pressure rates higher at some point in the long end, and force the Fed to, at some point again, start to be the buyer of last resort.
So you mentioned a couple of points there, and I want to go through them one at a time. So first, I'd like to follow up on your point that if the Fed keeps interest rates where they are right now, they would already have a huge impact overall. Let me have you elaborate on that, because it seems the economy right now is still holding up to a certain degree. I mean, markets have been doing okay. So let me just have you explain that.
I think there's sure. I mean, at first, financial conditions, believe it or not, have eased up since the beginning of the year, which I think it's a significant part of the answer for your question of why we have not seen further problems. But when you look at the cost of debt itself, which is higher than what we see as far as a Fed funds rate, meaning cost of debt for corporations is higher than 5+%. And if that's the case, at some point that is going to start to become more disruptive for some of those businesses over time. We haven't seen yet a lot of the debt that is in the system needs to be rolled at higher rates. And as that mechanism continues to unfold, you will probably start seeing, that's why there's a lag effect on tightening on monetary conditions. The problem is we've been in this tightening already for over a year now, and I think we're about to start seeing some problems here in the near future. The banking problem wasn't so much, in my opinion, caused by the Fed raising rates. It was caused because of the decline of Treasury markets. Okay, in 2022, I think people are getting a little confused in those two. I don't think that the big problem was that the collateral price of those instruments collapsed in 2022, and none of the institutions that depend on those collateral prices were expecting that to happen, because in fact it didn't really happen in the last 30 years. So it's not really, I don't want to get into that, but it's hard to it's just like the housing market in 06, 07, when folks used to say the market never goes lower, and then it does. And so it's very similar in that sense. It's it's almost like it is a black swan event, because no one thought about the unintended consequences of Treasury declines. Now, with the Fed raising rates, what it causes is that at some point it creates financial conditions to really tighten, and we haven't really seen that yet happen. So if you think about credit spreads and other things that are potentially at risk to cause some issues, I would say that those should be on the top of the agenda. I think we're going to be Now we're approaching this recessionary issue for the last year or so. We've been talking about this for a while now, and we haven't really materialized on that thesis. I would think that in the next 6 months or so, it's going to be hard to avoid a hard landing, and so especially after being already a year into a monetary tightening policy. And so if they do raise rates, the importance of that is the fact that we're getting more and more into this scenario or this camp of really tighten things and beginning to perhaps cause some issues. I think that if you look at the VIX, the volatility in equity markets, and the credit spreads, which usually tend to sort of price, not, I wouldn't call the health of the economy. That's not what I'm trying to say, but the health of the market in terms of, if things are going okay, you would expect that spreads would be very low and volatility would be somewhat suppressed. But in this case, I think that is not justifiable because certainly if you think about the risks of equity markets, given where valuations are, given where interest rates are, and given where earnings are likely to go, now I think that this is going to be quite different than what markets are pricing currently.
Yeah, I mean, there's a lot of contradictions within the market. We've been forecasting a recession since last year. And you said something interesting on Twitter. The government is sort of undoing what the Fed is doing with their inflation fight. I want you to elaborate on that because the Fed is trying to tighten monetary condition. Meanwhile, the government's aggressive fiscal policy is going in the opposite direction. Can you talk a little bit about that?
That's precisely correct, in my opinion. Undoing it because government deficits are at levels, first of all, relative to how low unemployment rate is. We've never seen such an aggressive fiscal policy. So, if you think about it, fiscal policy is supposed to be more excessive at times when you are in the middle of a turmoil where unemployment rates are historically high, you've got a recession already in place and so forth. And so the government spending increases in order to an attempt to fix the problem. And I don't think we're seeing that today. What we're seeing is large fiscal policy not related to a recessionary problem that has caused government to spend more. In fact, what's happening here is just a reflection of how extensive is the fiscal agenda. You've got social programs to a degree that we haven't seen in the last decades. You've got really the green revolution being part of that, the infrastructure developments occurring as a way to avoid Chinese reliance and Russian reliance and other authoritarian regimes that we've been dependent on. And military spending, which is historical lows currently, that is likely to continue to rise to levels that we've seen in the 60s or so, which were about 9% of GDP, and today is less than 3%. And so that is not to mention interest rate payment, because a lot of people think that the fact that the deficits are increasing has to do with interest payments, and that is partially true. It only accounts for about 50% of the deficit today. So yes, that will increase over time and will become more and more of a problem, most likely. Right now, GDP has to grow about 3% just to cover the interest payment. We're probably going to see that continue to increase. The debt is increasing at a astounding pace right now, and it's compounding in a way that it's scary. It is dangerous, and I think this is not the end of the world. All it's happening is creating a setup, in my opinion, for gold to break out from a triple top that has formed recently, which usually triple tops never hold. And as you can see, we are seeing institutions and central banks and large capital allocators looking at this scenario and thinking, what is my defensive asset? Is it really treasuries? And I don't think it is. I think it's really gold. And as we see gold becoming a larger portion of 60-40 portfolios, central bank balance sheets, and so forth, that is going to create the influx of capital to also cause gold prices to surge and go well above the levels that we're seeing today. So to me, that's the ultimate way of thinking about this. As I said before, when you think about the real bull case for owning treasuries is really on the premise of we in this system today of how levered it is cannot sustain higher interest rates, and therefore we should own treasuries. But if that's the real bull case, I would much rather own gold. I think it's a far superior alternative in this environment.
Yeah, I mean, you mentioned a lot of points there. I want to follow up on them, but it seems like I'm running out of time here. Let me just ask you maybe one or two more questions. In terms of a recession, so we have this aggressive government fiscal policy. I mean, so that's putting liquidity into the economy. So I wonder if that's going to hold up the economy this year. So the prospects of a recession, perhaps there's talks now whether that's going to happen. Maybe not this year, if at all, maybe next year. What are your thoughts on the amount of liquidity in the economy holding it up?
Don, that's a good point, by the way. You made exactly the point I was trying to make in that tweet as well, which is the fact that you see one institution conflicting policies, one institution tightening conditions, raising rates, doing QT, and another institution saying, let's spend capital in all these different ways or agendas that we need to be following up with. And then we also have elections, which you should see also the increase of spending in order to allow the current president to at least have a shot on trying to stay in power. And so all those things are going to play into this liquidity situation. What I think, unfortunately, will happen is that liquidity idea is more of the case when you also have large demand for the debt instruments, which allow the government to have that capital to then spend. And I'm not sure that we're seeing that. If we do see the Fed having to step in and buy treasuries in order to almost monetize the debt, that's a different scenario. If we get to that point, then you're right, Don. Then liquidity is going to be plentiful, and I think it's going to be a very different scenario than we're in today.
All right.
Will that happen? It could happen. Yeah.
I see. All right. Thank you so much today, Tavi. Always great speaking to you.
Thanks for having me.
Some Fed officials think that pausing rate hikes to ensure that the Fed doesn't go too far might help achieve the tantalizing prospect of a soft landing. This is the hoped-for scenario in which the Fed would manage to tame inflation without causing a recession, or at least not a very deep one.